It's so weird. It took me years to build a $500,000 portfolio, and then in 1 month, my portfolio is like, hold my beer. October was one hell of a month. If you've been following along, you know these gains have been in large part... Whoa. What's happening here? That's not 500,000. Down $140,000 today? Tesla, what's happening? What's happening, Tesla? A lot of red. I don't like this. Oh. Elon tweeted. This bastard selling his shares. My name is Nick. This is my lemonade stand. I'm a retired nurse that's now in the business of trying to stay retired. And sometimes Elon makes it a little harder than necessary. So I manage a portfolio that's made up of real estate, crypto, and equities, 70% Tesla at this point. I manage this portfolio and have been living off of it since January of this year. If you'll be so kind to indulge me, I updated 2 charts and created a new one just for you. I don't do it for me, I do it for you. First up out of the batter's box, we have this little gem. What we're tracking here is a theoretical safe withdrawal rate of my portfolio. It's theoretical because at the moment I'm burning through a cash position to pay for my existence and not relying on the sale of equities, dividends, interest, or rental income. Also, what is considered a safe withdrawal is up for debate. On this graph, however, the tall columns you see here in black represent my income annualized, which is equal to 4% of my portfolio plus rental income. I exclude interest and dividends. Currently, my annualized income is over $80,000. Now, the shorter columns you see here in green at the bottom of the chart, those are my annualized dividends. I don't focus on dividend income per se. Frankly, I prefer companies that don't pay a dividend from both a tax efficiency and a capital appreciation standpoint. Dividends are just not my thing. But you do you. If dividends get you up in the morning, by all means. I do, however, have to work with them. They're a reality of the game I'm playing. So that's why we're looking at them. At the moment, 100% of these dividends get reinvested back into the portfolio, but in the future, I'll use them for the cost of my living. Because I'm being forced to realize these dividends by the companies that I own that pay dividends to their shareholders, is capital that's being returned to me in the form of a dividend, along with any income from rent and interest earned has to get used first. Effectively, this reduces the amount of equity I have to sell or borrow against to fund my lifestyle. Next chart here. This is super important. What we have here is a chart showing my debt relative to my equity. So the largest portion of the chart in green on the bottom here is my portfolio value X real estate. The red portion in the middle is my debt stacked on top of that portfolio value. And the top sliver of green right there represents my equity in real estate, which is shown stacked on top of the debt. The greater I can safely grow the red portion, my debt, keyword of course being safely, the more I'll be able to grow the green parts of this graph. So how does that work? Well, when I borrow, which in turn grows the scary red portion of the graph, a few important things happen. First, and this is really obvious, if I'm borrowing against the equities, this means I'm not selling equities, right? And if I'm not selling equities, this means the expected returns on said equities should be higher in the future. One would reasonably presume if you have more shares, it's worth more in the future. And this is true whether I'm borrowing to buy a cup of coffee, a condo, or a publicly traded company. Preferably, if I'm borrowing, it's to buy assets that are appreciating. Alternatively, if I sold assets to buy a cup of coffee, a condo, or a share in a company, the number one issue would be the opportunity cost of trading one asset for another. Selling even a fraction of Tesla to buy a cup of coffee could cost me greatly because the fractional Tesla share in 10 years will probably be worth a lot more than a cup of coffee. Knock on wood. Now, if I were playing this game, I'd much rather trade Tesla for another appreciating asset. But even then, I'm just shifting the risk around, creating a tax event on top of it, and I'm attempting to outsmart the market, which I think is a losing strategy long term. Now let's keep going down this coffee hole. Regarding opportunity costs, for about a quarter of 1% of a Tesla share, I could buy a cup of coffee today. Now, the question is, in 10 years, what value will inflate more, the coffee or the Tesla share? Now, I'm going to go out on a limb here. I wager that a quarter of 1% of a Tesla share will buy me more coffee in 10 years than it does today. So it probably doesn't make sense to sell Tesla, or any equity for that matter, for coffee, right? Conversely, if I borrow, the dollars that I borrow now because of inflation will most likely buy me less coffee 10 years from now than it does today. I think this is well understood. I mean, if you're buying coffee, you're not selling an asset to do it. You're probably paying cash, or you're using credit, which you will eventually pay back in cash. But I'm retired, right? I'm not working. I'm not trading my time, my labor for money. So if I don't have cash to work with, then buying anything comes down to either selling assets or borrowing against those assets just to make a purchase. Selling assets mean I don't have to deal with debt, which is good enough reason for most people. But selling assets that have appreciated has tax implications. And then clearly selling assets means I have less assets, which will no longer grow in the future. Thus, whenever I can safely borrow, I can both avoid taxes and increase future returns. So why not borrow indefinitely? Well, sometimes you can have too much of a good thing. Coffee, to stick with that example, too little and I can't get out of bed. Too much and I'm a jittery mess. I also won't be able to fall asleep. There is a therapeutic amount that's just right. The Goldilocks level of debt. And that's a very long-winded way to explain this chart, but that's how I think about debt. I imagine it's going to continue to grow over time, but it should be pretty small relative to the greater portfolio. This chart up here better reflects that debt to equity ratio. Currently, my debt makes up 21.5% of the total pie. If we include real estate equity here, that number drops to 19%. My sleep well at night number is probably below 15%. So we have work to do. And to illustrate this practically, here on my M1 account, you can see I have a credit limit of $578,000. Down quite a bit since that Elon tweet, but that's okay. Of that $578,000, I have $470,000 borrowed, which leaves me with $108,000 of available credit. Let's say I decided to utilize $100,000 of that available credit. I simply smash this blue borrow button up here, perhaps in the same way you'd smash the like button on this video. Here you got a one-time transfer, $110,000 available in the borrow account. Let's just move me. Voila. If I hit this continue button, $100,000 immediately available to me. No fees, no questions. It's mine. So now I have to do something about it. Let's escape from this screen. I don't want to accidentally hit that button. Oh God. So if I bought assets with that money, that $100,000, and it compounds at, let's say, 10% a year, that's $10,000 of potential growing income that would increase year in, year out. And I just created with a flick of a button. Now, there's no free lunch, of course. The credit would cost me $2,000 a year. Okay, so now we're looking at $8,000 a year of growing income created at the flick of a button. Not too bad. But this is when you factor in that sleep well at night factor, okay? First, that 2% cost of capital isn't set in stone. It moves with the Fed funds rate, so that's a big factor to consider. And then, of course, there's risk of margin call. If my portfolio lost, there we go, 50, why can't I, there we go, 55% of its value, or about $1 million, $930,000 right there. I could be forced to sell my positions when they're worth much less than they are now. So that's the rub. With a little amount of debt, you can boost returns. However, with a lot of debt, we run the risk of boosting ourselves into financial calamity. That's a no bueno. All right, let's take a look at the last chart. This one's new. Exciting. The green columns here represent actual cash flow my portfolio puts out in the form of dividends, interest, and rent. these cash flows are relatively stable, but a little lumpy. The October cash flow here on the right is a little lower than the September cash flow, but it's greater than the August cash flow all the way on the left. That's because dividends, which make up about 40% of this income, have a bit of a lumpy payout, and that's what you see reflected here. What's really important for me to pay attention to is my free cash flow. Free cash flow is the product of my cash flow minus expenses. So this negative free cash flow means that my cash flow, that's the dividends, interest, and rental income, does not cover my living expenses. Right now, I'm avoiding borrowing or selling assets because I can pay these expenses with my cash position. One day that might not be the case. My cash position may eventually be depleted. That's where these gray columns come into play. They represent my safe withdrawal, which we saw illustrated on that first chart. If I continue to have negative free cash flow, my financial health will remain strong just as long as these gray columns are larger than the corresponding negative free cash flow. You can see in October, all the way on the right side of the chart, I did a really good job at reducing my negative free cash flow. It almost disappears. I think it was only like $600 in the hole, whereas in August and September, I lost over $3,000. Now, I think in the long run, I can actually keep it at around this October level. I do have some big purchases coming up in the next couple months, so it's going to get worse before it gets better. But next year, I'm projecting that the free cash flow will be close to this October level. And I think that bodes well for the portfolio in the future. All right, I think we'll wrap it there. If you haven't already, hit the like button, subscribe. I promise it will have no effect on your cash flow. Well, actually, yeah, we'll save that thought for another day. Now get the hell out of here.